And obviously it's semantics in some ways, but it does matter in terms of sort of how investors think about the markets and what investors do in that market. So the relevance of saying this time it really was different. Walk us through your thinking.
Well, the bear market lasted from February 19th through March 23rd. So it only lasted 33 calendar days, and that was actually 23 trading days. And of those 23 trading days, during 7 of them, the market was down 20% or more. So it really was basically a 7-day bear market. And I don't really believe that that should be included in the record books as a bear market. It's really more like a panic attack. And I think the relevance is, if in fact it was a bear market, and that's the way you want to look at it, then I guess the question is, was this rally just a rally in a bear market? I don't think so. I think it was a continuation of the bull market that we had that started way back in March 2009.
What on earth is the justification for this, Ed? I mean, fundamentally, the economy is, just in a deeply bad state. The Atlanta GDP now figure improving, but still at minus 48% for GDP. And then when you look at earnings, we just had Bruce Richards talking about potentially year over year next quarter down 30%.
Sure. Well, you're right. I mean, from a fundamental perspective, you can say that it's a bear market because bear markets occur during recessions, and there certainly has been a recession. And as a matter of fact, the National Bureau of Economic Research just declared that the peak in the longest economic expansion of all times occurred in February. Some of the press has been picking it up, saying that the recession started in February. It actually started in March. But you know what? It may very well be over in May or June. I mean, in some ways, this is more a natural disaster than it is a classic recession caused by credit crunches and all sorts of other excesses that lead to a significant and long decline in the economy. This could very well be the shortest recession of all times. Basically, it would cover the second and the first quarter and the second quarter, but in terms of the monthly pattern, it really took a dive in March, and that was just the last 2 weeks of March. And then April, it took an even bigger dive. That's when we lost just about all of the. That's where all the negatives came in. But we're starting to see some indicators bottoming in May, and the outlook is that many of them will bottom in June.
We are seeing, Ed, obviously a kind of a rotation into the businesses that will lead us into the future. We're seeing the NASDAQ here breaking 10,000, that NASDAQ 100 for the first time pass in history. As a longtime watcher of these markets, I just want your kind of check on valuation here. And in the context of, we had this sharp, issue we had to get past. We could even go back to January. What do you make of the value of these markets?
Well, very often you do get melt-ups in bull markets, and they usually occur near the tail end. But everything is sort of all over the place in terms of comparing what's going on now to the past. Let's just say that the bull market that started in 2009 is still intact. We may actually be seeing the melt-up phase in the market. I hope not, because if this thing becomes too much of a bubble, then we're going to have a whole other problem within the next 6 to 12, 18 months. But valuation is not cheap. But it's hard to measure valuation off of actual earnings right now because actual earnings are taking a dive. The market is clearly looking beyond the abyss right now. And the market is basically saying that for all the terrible things that have happened, the underlying earnings capacity of most companies has not been affected, that they are going to come back able to earn what they were earning back in late 2019 without that much duress.
I guess one of the questions that would upset that progress back to kind of where we were is indebtedness, especially on the consumer side, that would tip people over into bankruptcy, that this would be kind of the last straw, these few months interruption. You're not fearful of that?
Right. Well, I think there are going to be some aftershocks from what I call the great virus crisis, and the aftershocks will very much be in the areas of debt problems, because clearly there are going to be a lot of businesses, particularly small ones, that are going to be very happy to be reopening over several weeks, but they will be restricted in how many people they can actually have in their establishments, which means that they really have to control their costs, or else, 50% just capacity isn't just going to make for a good business for a lot of these companies. And so there could be a wave of distressed companies. But keep in mind, the Fed hasn't even started to make out something like $4 trillion worth of loans to Main Street.
Yeah.
This whole recovery is all about the Fed, and the Fed isn't done by a long shot.
No, and in fact, they're actually speaking in Washington as we speak, Ed, and we'll get another statement tomorrow. Do we start to inch towards yield curve control?
I don't know that we're going to need it. I mean, they're basically controlling the yield curves simply by their quantitative easing program. I guess we're on QE4. I call it QE forever. And there's just an open-ended commitment to just keep buying securities. And that's certainly done a very good job of keeping the bond yield under 1%. I guess if they feel like the markets are fighting them and they need to keep that yield under 1%, they could announce that they're pegging the bond yield at below 1%, but I don't think it's really going to be necessary.